nobody knows the future. If you do not define value, you cannot digitize it. So my theory is a theory of complexity. That's why it becomes theory of open banking, it becomes theory of open finance, it becomes theory of platform ecosystems and how to make them happen to make sure that we build value for everyone. On platform economies, we can find different ways to address the problem of information asymmetry. So institutions need to be ready to build platforms in a way or participate to platform building in a way they can participate to the generation of value across the whole ecosystem.
Hello, welcome to Andersen R&D channel. Today our guest is a global research leader in banking and financial markets at IBM, advisor, entrepreneur, Paolo Sironi. Paolo, thank you for being here.
It is my pleasure.
If you don't mind, I would like to discuss with you the subjects you work with most: economics, FinTech, digital transformation. Paolo, in your interviews, you often joked about Lufthansa being your living room. What locations are in your next business travel plans and how much rest do you manage to have?
I do confess that I traveled a lot, possibly too much, in the last few years before the pandemic, of course. Sometimes I was flying east and coming back west. But I've been learning a lot, meeting so many colleagues, clients, and entrepreneurs. And through the pandemic, I guess that I moved from Lufthansa office to home office without passing through the office. Now, business is reviving again, client-facing, so there's more happening. In particular, the coming months will be more dedicated to the European continent clients. But what I want to tell you and share with you is what I learned from this extensive travel. And I might simplify a little bit the world stage, so all forgive me if I'm not comprehensive, but let's say that digital innovation was born in the United States of America, California, the Silicon Valley entrepreneurs, largely speaking, a lot of technology conversations down there. Europe is where a lot of regulation is born, and that's also important. The European Union has to harmonize the Capital Markets Union, and the European Commission has a strong interest to protect the consumer and the investor. That is important. But the real beneficiaries of the FinTech innovation live in Asia Pacific, in particular in China and in India, I would also say, and other countries around, because there the business models are born and then transform the way people interact through technology with financial services. So my role in the last years, which is reflected in my advisory roles and in my literature, is basically to understand those business models that want to excel on digital, knowing that what might work in Guangdong, China, might not work in Bavaria, Germany. Then understand which exponential technology can help to scale up these business models, reminding me all the time that not all of the exponential technologies are at the same level of maturity. For example, what artificial intelligence can do today could not do 10 years ago. But then in the end, we all have to keep everything within a regulatory framework to make sure that we do good for the enterprise, but in particular for the clients and the broader community of individuals that operate in our economies. And my approach is always an institutional approach, trying to identify how regulation can be a proper engine for innovation as it can address the way business models can change together with the usage of information technology, that is artificial intelligence, quantum computing, blockchain, all of these new capabilities that you see are available to the entrepreneurs and the bankers today.
Let me remind you, my name is Denis Astapchenia. I'm head of financial technologies at Andersen IT company. Our research and development department works on the content for this channel and also collects the best practices of FinTech software development. You can view the examples of such case studies on our website. The link is in the video description. If you need to go digital, cut operational costs, or automate business processes, we will offer the best possible solution for a business case. Contact us. So, you had an intense and diverse career journey. You started leading a quantitative risk management department in capital markets. You became a startup entrepreneur focusing on the digital transformation of wealth managers. Currently, you lead the thought leadership research of IBM globally for banking and financial markets. And I can't miss to mention your business literature and contribution to economics, fintech, and platform theory, what is your main personal or business takeaways from your experience so far?
Quite a good question. I once said that my personal and professional journey is like the journey of Dante Alighieri in the Divine Comedy. The poet went from hell through purgatory to heaven. And in a sense, is what happened to me. I started as a risk manager. You know, risk managers see all the sins and saw all the sins of the financial system, also those you don't know yet about. Then I became an entrepreneur, and it's painful. You want to make something happen for the good. You make mistakes, you get punished, but then you might be able to succeed. That's when I joined the heaven of exponential technologies, companies that excel in the creation of artificial intelligence, quantum computing, you name them all. But as much as Dante was not about discovering God, but discovering himself, his real soul, I made a journey through the foundations of myself and Homo sapiens. So I started investigating what really makes human beings different when they treat the financial problem compared to other ways of consuming, like e-commerce, for example, or social media sharing. And that enabled me to identify these biological macro foundations that needs to be respected by all of the digital entrepreneurs, because once they understand them, therefore they understand the human being, its value, and they can digitize value. If you do not define value, you cannot digitize it. This is the core of my financial market transparency theory in principle. I guess we'll have time to discuss some of this concept in the interview today.
So, after all the upheavals, the world begins to adapt to life in a new reality. Structural changes are taking place in the economy, but the pre-crisis momentum has not yet been gained. So what are the main issues that need to be solved today to overcome the crisis and continue further development?
Well, you might have said at the beginning, I was born an economist. I became a professional in quantitative risk management and finance. I'm a digital technologist nowadays. The core of my thinking is always about the nature of reality, which is fundamental uncertainty, and how we relate to that reality as human beings or human beings that use technology. Now, the Econ Committee, a couple of years ago, 3 years ago, released a paper when Ms. Lagarde took the reign of the European Central Bank to suggest what the European Central Bank, so any central bank, should take care of in the coming years. So the economist of the Econ Committee for the European Parliament said that there are 3 priorities. The first one, of course, the problematics of negative interest rates, the excessive quantitative easing, so the conundrum, how could financial institutions and central bankers disengage from their own actions. The second is, for the Europeans, the completion of the capital markets union, which is still incomplete and need to be resolved. But the third is the most important. They said that we all know that we live in a world dominated by fundamental uncertainty, by all means. And it is a characteristic, they say, of fundamental uncertainty that it cannot be measured. So they've been advocating for central bankers and policymakers to find ways to shape their decision-making, to remind themselves that not all the data we have at hand describe the reality, therefore the model can be faulted, there has to be a change in approach. Now, my literature is underpinned by the positive theory of financial market transparency, which recognizes the primacy of fundamental uncertainty as the structure of reality and also the structure of data and big data, and therefore dictates a way to generate business models to relate to the problem that can open up the reference framework to make sure that we don't get lulled by our own convictions, and therefore we allow economic models, business models, regulatory decisions to open up the reference framework to reality and to make attempts that might go in the right direction to make our economic system more anti-fragile. Now, in essence, since fundamental uncertainty is a structural reality, that means reality is complex. So my theory is a theory of complexity. That's why it becomes theory of open banking. it becomes theory of open finance, it becomes theory of platform ecosystems and how to make them happen to make sure that we build value for everyone.
Talking business model transformation, in your last bestseller, Banks and FinTech on Platform Economies, you write that the banking industry is at an inflection point caused by increased regulation, digitalization, and changing investor behavior. In what direction do you think FinTech startups should move to be successful and competitive today?
I believe there was a fundamental flaw in the expectation of many FinTech that we saw so clearly in the last 10 years. Everybody started 10 years ago, attempted to unbundle financial services, basically to break the banks, adopting very narrow-minded business models, hoping to make it happen. However, I always told the thousands of FinTech entrepreneurs and bankers I've met in my career that they can't break banks for the simple reason that banks are already broken. That means they operate like these joint business units where one side of the game might not know what the other side of the game is doing. You can think about a corporate entrepreneur. He might deal with corporate banking with a bank, and with the same bank, he might deal with private banking by different people, different KYC processes, so everything is in different silos. There's not a consistent and comprehensive view of the client, so the client is not capable of paying one price for all of the relationship with one institution. Now, it is clear to me that in order for banks to make it happen and FinTech help banks to transform in the right direction, the effort is to rebundle banking through FinTech innovation with a different perspective. And that perspective is the one of the ecosystem platform, the platform economy, that requires all of the division lines among the business units, as well as those dividing banks and partners, to be turned down to create something new that engages the customers in different way, in a way that the customer knows the customer is always one in that relationship and doesn't have to fall into a subsequent set of steps that create a lot of friction and so much disappointment in the banking experience. So the core here is to bundle back banks on the platform economy, look at the prevailing strategy that I clearly identify in my latest work, Banks and FinTech on Platform Economies.
Could you explain what is the key difference between output economies and outcome economies?
Yes, so essentially bundling back differently means that the focus is not the output that creates silos, the product. The focus is the outcome, that means client engagement and journey. I'll give you an example comparing financial services with the automotive industry. In the automotive industry, a car maker might decide to sell X number of cars next year. So in this case, the goal is the outputs, quantities of cars. But the car maker might learn that more and more individuals might want to use a car personally to go from A to B without owning the car. They don't have to buy the asset. That is car sharing. So what they create is applications that enable people to subscribe to a car sharing mechanism and basically to fulfill their need, going from A to B by self-driving a car. Now, the asset does not disappear, the car, but you see, it moves to the periphery of the business model because it's not bought by the client. The consequence is that if you buy an expensive BMW and you realize that the driving experience is not that good as you expected, most of us cannot take it back. You need to keep it for a while before you have the chance of selling it to somebody else. But if you don't like an experience with the car sharing app, you quickly move to the next one. So those owners of the business model are more exposed. That's why they need to excel with client engagement and client experience. So what about banking? We can make an example about wealth management. A wealth manager might decide they want to sell 1 billion units of a monetary fund the next year. So it's quantities of assets under management attached. There are fees and commissions. But when the wealth manager decides that the scope is to help their clients, being personal, families, entrepreneurs, to fulfill their journey goals, that means personal, financial, or business goals, they transform everything in the relationship. So the attention is not anymore focused on the individual product, as those are not the element that will be generating most of the revenue in the end, the focus in enhancing the possibility of these clients to fulfill their goals. That means going from A to B in their personal, business, or financial life. And that is, in essence, the outcome. So the shift from the output, which is the product, to the outcome, which is the goal, transforms the monetization mechanism. Therefore, the old business model, as a consequence, everything beyond that through technology, like the configuration of the organization.
Today, it is often said that a new generation of investors has appeared in fintech. What is it like? They invest from cryptos to meme stocks and NFTs. Which investments will bring the greatest profit from your point of view?
Well, I guess there has been quite a few misunderstandings or misconceptions about the essence of decision-making processes for individuals, a lot of narratives about the digital natives and the millennials. We said that the structure of reality, fundamental uncertainty. Nobody knows the future. So even the millennials don't know the future. So they're not different in essence from other individuals needed to make financial decisions that somehow can become very complex. So I give you an example. A few years ago, I was talking to the CEO of a very prominent robo-advisor. And he was telling me that at the beginning of the journey, they grew the asset under management a lot to a few billions. But then they stopped growing and they weren't sure why that happened. So I asked them whether we could verify his assumptions. So I asked what was the average age of his customers. And he said 50 years old. So you see, they are not the millennials. So I asked him, what is the average value of the portfolios invested in the robo-advisor? He said $35,000 to $40,000. So I said, you see, it's not the small money like the $1,000 or the rounding of the dollar that these people can invest. They can already invest more. And so I asked, what is the type of investment they prefer? He said 60% are invested in the retirement plan. So basically, this indicated these might be individuals that are already accustomed to investing, so could onboard on a self-directed advisory mechanism, the robo-advisor, in order to make the decision. But the majority of the clients are not like that. So they might spend $1,000 to go marketing, but they might meet a person that is inclined to use the robo and another person that loves the brand, but is not so sure because cannot resolve the dilemma of the fundamental uncertainty. Would they make or not a decision? That's why I invited them to look for an hybrid model, so to plug in a human advisor whenever is needed. They started growing again. And in the end, you see that this is the prevailing model today in the wealth management world, an hybrid model between advisors and technology. Now, I know that through the pandemic, there was grand hitting of the drums about the retail trading, so a lot of young individuals accessing trading platforms to invest into the next fear of missing out, the FOMO, being the Bitcoin, the meme stocks, or the NFT. Now, here is the problem. Those decisions are not conscious decisions. The FOMO is unfortunately there to convince us that we have a strong and good opinion about the future, but in reality, we don't own the future. The market can tumble and we can be exposed if we were not already aware of that to build up our investment strategies in a way to be more sober and anti-fragile. And the FOMO cannot be, in essence, leveraged by a robo-advisor that sells model portfolios. So they basically would like the narrative or the self-referential narrative to convince the clients. So they have to do more. Everyone needs to do more. And this is the reason why the way out is really to transform the relationship in a way. Advice is given to people to become more conscious to making those decisions. It's not about individual investing, it's about resolving the holistic problem of financial planning, which is effectively emerging today as the main criteria to transform the business model of the major banks worldwide, at least those operating in the Western world.
Why do you believe that understanding the real nature of the information asymmetry is foundational to successfully address the digitalization of financial services?
This is super important for everyone, also for those investing in fintech, because by understanding what I call the pull-push motivational gap that explains the asymmetry of information, they understand how difficult it is or not to digitize financial services. And my point of view starts from the realization that the way human individuals, the Homo sapiens, makes financial decisions is different from the way we make decisions when we buy on Amazon. So we need to be very careful, though I might make some example myself, when we compare different domains, different experiences, especially when we move from consumption to investing. And many assumed that the mechanics were the same, so they got disappointed when they invested into fintech startups. So let me explain to you this way. Let's imagine how a global financial institution is organized. There may be 4 business units. Let's say payments, credit, investment, and insurance. And I mentioned them in the order of the intensity of the asymmetry of information they expose the clients to, and also the diversity of the consumption model from more self-directed to an intermediate model. So let me explain. Payments typically is very symmetrical because when you buy a Gucci bag, you immediately know that you're happy to make that purchase. Sometimes the payment providers are opaque and you're not necessarily sure about all of the commissions that you have to pay for. So in the lack of transparency, you might be inclined not to care and you're happy for the transaction. There's no surprise that the biggest unicorn started appearing in the payment space because it was more symmetrical. They could capture a large number of users to trust the relationship and to enjoy the new mechanics. Now let's move to credit. Credit is not so symmetrical because sometimes the decisions for a family can be very complex, but in essence, you get money to buy something. So let me give you an example for you to understand that I might be pushing a little bit. I am asking you, Denis, to go to my website at thepsironi.com and click on the first image you see. If you do that, what happens is that I will give you $1,000 that you can invest and you can use, and there's no interest rate, and there's no commissions, and you can give back the money whenever you want. So it's like free money. I'm sure you may want to do that, and maybe many in the audience wants to do that, but I have to remind you that I was a risk manager, so understand how problematic it is to lend money to people, especially when it becomes unsecured lending. So only those fintech or banks that can afford, they have large enough shoulders to grow, especially with unsecured lending, they can use this mechanism to onboard clients. Because in the end, there could be an issue in terms of the sustainability of the business model. Now you saw that a lot of platforms that operate like a peer-to-peer mechanism misunderstood some of these risk management concepts, and others started growing with the buy now, pay later, but learned that they may not be truly sustainable because the risks they engage with might be larger than the benefits they got at the very beginning of their expansion. Now let's move into the third example, which is investing. I'm now inviting you, Denis, to go back to my website. You click again, but on the second picture, and now you give me $1,000 that I will invest for you in a model portfolio made of cryptocurrencies, American stocks, 10% of Chinese stocks, maybe not those in Guangdong because I believe they pollute and I want to be ESG, you name it. Now, you might be frowning. You might be checking my profile on LinkedIn. You might be asking your friends, is it true that Paolo wrote literature on portfolio optimization? Is it true he worked in capital markets? He was a quantitative risk manager. You see, you may not trust me immediately. There is a distance. And that is the asymmetry of information. You don't know, you face uncertainty, you want to be cautious. So you see that the robo-advisor started growing effectively among those folks that were more inclined to invest, but without a human relationship to close the distance, they had a problem in scaling up their business model as fast as they expected at the very beginning. And let me give you the last example, which is the most asymmetrical industry of all, that is insurance, because insurers really deal with uncertainty to the extreme. Let me say that I want to discuss with you an opportunity to buy life insurance. I have to tell you that you're going to die. I bet you don't want to have this conversation with a chatbot. So you see, the more the asymmetry of information intersects the intensity of the fundamental uncertainty, the more the model becomes hybrid, a mix between analog and digital. And if you don't understand that, you may trash the money and do not resolve the equation of digital transformation with fintech innovation.
Despite numerous blockages and recent reassessment of venture capital evaluations, the financial services industry continues to invest in technology and innovation with even more enthusiasm. And in your latest bestseller, Banks and FinTech on Platform Economies, you talked about new business models based on the platform business models. Are these capable to address the information asymmetry in the right way?
That's exactly the key point. On platform economies, we can find different ways to address the problem of information asymmetry and create value for everybody that participates into the platform interplay, up to a broader ecosystem that goes beyond the next customers that might engage with the financial institution or the firm at the very beginning. Now, you can think about it this way. The more the platform reduces information asymmetry, the more positive network effects click in, so the platform interplay grows because everybody trusts the generation of value, the sharing of value. The more instead the platform creates new asymmetries of information, could be opacity. For example, the fake news is an example. The more the negative positive effects click in to the point that the platform can collapse by itself or because of regulatory decisions. So the information asymmetry and the transparency that enables that to be resolved are the key engines that make platform economics fly, succeed, or not. Let me give you an example for the audience to understand. Most of them might have come back from vacation recently, and I know the feeling when you book a hotel, you go there, and reality is not exactly what they look like on the website when you check those pictures. Nowadays, you can access platforms where a variety of different users that went to that hotel before could share their perspective and their pictures. So you have a more substantiated opinion about what is reality. So the asymmetry between you and the hotel owner is reduced, so you can make a better decision, and therefore you feel value, and in the end, you may engage with that platform for the final booking of your journey, as an example.
What are contextual banking and conscious banking, and why these platform models can outperform linear businesses?
So now you refer to the two platform strategies that I identify in my research and explain in my latest work, Banks and FinTech on Platform Economies, Contextual and Conscious Banking. As we just said, the issue here is to free value that is constrained by excessive asymmetry of information. And in financial services, that opportunity can happen with two different strategies. The first one is contextual banking. Contextualizing banking means that you use banking digital capabilities to eliminate friction from an ecosystem interplay. It's like the one click on Amazon, to give you a brutal example. But basically that means that your capability to complete your journey in a different industry is more simplified because you can leverage digital technology to consume financial services. So then it is the elimination of the friction that creates new value that makes banking embedded, that allows you basically to transform a client journey. But mind that there's something important here. The monetization might not occur in due time on the mechanics used to eliminate the friction, because they themselves commoditize. So institutions need to be ready to build platforms in a way, or participate to platform building in a way they can participate to the generation of value across the whole ecosystem. There is another strategy identified in my literature for the removal of these asymmetries, and that refers again to the problem of value. And it comes up when bankers realize that to continue the journey of engaging with clients within their industry definition, so the client knows he's dealing with a bank, is not contextualized in a different industry, they have basically to demonstrate value. Because it's very difficult today, as products are commoditized, uncertainty is very high, to demonstrate that value. So now, it is the need to demonstrate value that makes banking conscious. That means transparent in front of the client in a way that they can be capable of making financial decisions for the long run in the consideration of everything that relates to their financial, personal, business problem. So there is a shift in terms of monetization towards paying for accessing the advisory or the planning fee that can be justified if clients recognize value. So value needs to be transparently discussed so that it can be paid for. So you see, both contextual banking and conscious banking attempt to resolve the pull and push motivational gap, reducing the asymmetry of information, but doing it in two very different ways. One, contextualizing into another industry to eliminate the friction, and the other one instead unlocking hidden value in the relationship that now is buried through stratification of habits, but can be let breathe again in a way that the bank can ask the client to pay for services differently outside the product, inside the advisory relationship.
And as I understand, these new models for the consumption of financial services and the accelerated digitalization in the sector require banking institutions to adjust their development strategies and begin an actual transformation. So where to start, and what are the main investment areas and the criteria to drive change successfully, in your opinion?
Indeed, a good question. The journey is complex. So in order to simplify it and help people connect the dots, I created the Banking Reinvention Quadrant, which is a business value space where you position yourself today as a firm and where you want to go into the future. The Banking Reinvention Quadrant has two axes, named information and communication. These two axes are taken as a definition from an interesting paper of the Economies, the researchers of the European Central Bank, that 2 years ago, in a work titled Financial Intermediation with Technology, What's Old and What's New, said that financial intermediaries excel in market power if they excel in information and communication. So communication is the vertical axis. It means that since it's not possible to remunerate the data within the existing industry definition after the price for risk because of negative or very low interest rates, a lot of compliance requirements, it is important that the bank opens up the borders towards ecosystems which happen outside their industry definition. So it is open banking and open finance. So build banking as a service type of solutions that leverage what? Hybrid cloud in order to collect through a data fabrics all of the data elements which are needed to understand what the client is doing and what the client is needing in the end. So the information quotient means excelling in the opening of the core banking systems with a banking as a service type of architecture to engage through hybrid cloud in a different consumption of data, secured and immediate. The horizontal axis instead is communication. So the researchers say that communication is basically the relationship, is the interface, being a human or today more and more mobile-driven interface. Now that is where a lot of value is positioned in front of clients that need to make cunning financial decisions. And that is where you can start thinking on how you can leverage artificial intelligence that, underpinned by an open architecture which is robust and secure, allows to generate better insights that in essence has two goals. On the one side, to help those clients which are already inclined to self-direct themselves to consume in a self-direct modality, so to be capable of pulling from the mobile application, for example, the investment opportunity or the credit decision. On the other side, instead, for all of those clients which are still heavily exposed to the problem of dealing with fundamental uncertainty and need a relationship in order to make the decision, is about institutionalizing the work of the advisors and the planners to give them better information, a better context about their clients in a way they can fulfill their job and help the clients at a lower cost, because relationships are effectively expensive, so that a higher number of the population can be serviced inside an advisory relationship. So you see, on one side you have cloud and the data that comes with on an hybrid estate. On the other side you have AI and the relationship that can be supported by AI. These are the two elements where banks have to invest too in order to excel on platform economies by generating contextual banking platform strategies and conscious banking platform strategies. The first excel way more in information compared to communication. The second excels way more in communication compared to information, but they need to improve on both dimensions at the same time.
And proceeding with this topic, could you please provide some specific examples of contextual banking and conscious banking?
Well, let's think about some banks that decided to move in that direction. An example could be a bank in India that wants to build, actually built already, an agri-farm platform that allows the ecosystem of farmers to aggregate their business journeys by connecting the one to the other. In essence, the scope here is not to sell per se financial services, but to help the farmers resolve their problem, which could be leveraging weather forecast based on artificial intelligence in order to make decisions about their crop. Once that is done, so once the business value is resolved or addressed for the farmers and the farmers are engaged, then the farmers may also need to access financial services in a contextualized fashion. For example, leasing for machinery or trading the produce of their activity, the one with the other. So you see that the bank started by contextualizing, so resolving the business problem of the farmers, and there inserted financial services to remove the friction so that their business journey could be fulfilled or made in easier terms. Another example, instead of conscious banking, which is, I would say, still a longer road to go to, is about quite a few institutions in the Western world that are attempting to transform the monetization in front of their clients, shifting from a product monetization to an advisory monetization. You can think about some banks that want to penetrate the US, for example, from Europe, by providing portfolio management at zero cost for free, but then asking the clients to enter into an advisory relationship where the monetization is on that relationship. So the client is conscious about the advisory relationship, needs to recognize the value in the relationship, either in the relationship, and pay for that. The same happens for quite a few of the North American institutions as they realize that it is not possible to build sustainable business models in front of the customers as product placement mechanisms only, especially because the margins inside the products have been reducing to the extreme. You think about passive investing and zero fees for the trading of the ETFs. Therefore, they are now learning to build advisory platforms where they provide the means to the advisors to connect with the clients for a lower cost, focusing on what matters. And the clients will have to pay for the relationship. So you see again, the monetization changes and shifts from the product, the output, to the goal-based investing framework or the planning, which is the outcome.
You write that there are several keys to the future of banking: trust, openness, advice. Why do you think these aspects are so important, and should banks and fintechs shift their focus from selling business results to selling customer results in this regard?
They are absolutely important. I would say they are foundational to accelerate the capability, the opportunity for fintech entrepreneurs to make it happen. And I want to explain that to you with a personal example that also intersects the history and experience of Jeff Bezos. When I was his manager in the 1990s, I helped my brother in my spare time to build a startup. My brother wanted to create the Amazon of Italy. How ambitious. But we had the best of Italy at our disposal. We had fashion, food, furniture, and travel. We had a slick web design. We thought we can make it happen. But you know what, Denis? We didn't sell a dime. It didn't really work. But a wonderful entrepreneurial experience. Now, we made many mistakes, and I'm grateful to my brother for the enthusiasm that he put into all of this. But I think the one in particular I learned years after when I listened to an interview of Jeff Bezos. And you're not my age, but people my age might remember that at the beginning, Amazon was primarily a place where you could buy books. So the journalist asked Jeff Bezos, "What's Amazon?" And Jeff, with his spirited eyes, responded, "Amazon is not a distribution channel of products." I was puzzled. I thought, it is not. I thought that I can buy books on Amazon. So he explained the concept, saying that the publishers were sending him letters complaining that he allowed the users, so all of us, to post positive and negative reviews. And they said that he does not understand marketing, now called Jeff Bezos stupid, because they said, publish only positive reviews so we can sell more books. But Jeff Bezos argued back that they were not his clients. The clients were people like us, people that on board on the platform, but as that is digital, they cannot take a book, touch it, smell the glue as I usually do when I have in my hands a new book. So we might be there, but will not be capable of making the decision, which is the right book for us. So now the positive and negative reviews, he said, created that transparency element, the transparency competitive advantage that generates trust. So people started trusting and buying on Amazon, and then he expanded the Amazon capabilities. And also added only after he could resolve that element, he could plug in analytics to, if you like, enrich the experience of the client in order to position new opportunities. So in essence, for bankers, it means Jeff Bezos said that Amazon was an advisory platform. He used that word. So bankers cannot be a distribution channel of products as much as at the very beginning of Amazon, Amazon was not a distribution channel of books. So banks needs to become an advisory marketplace, an advisory platform where people can resolve their motivations facing fundamental uncertainty, so the pull and push motivational gap, to make it happen. In essence, we talked a lot about data-driven banking, which is important, but if you look at the banking invention quadrant, that is preceded by something which is even more important. That means data enabling client. Only when the platform enables clients with transparency to trust, the client can start moving, and then data can be generated and the relationship can be effectively optimized or improved. But that is an essential precondition. Transparency as a competitive advantage to build the trust on an open marketplace.
So Paolo, you encounter a variety of institutions who are eager to adopt their business models to the platform economy. So what problems do you have to face most often?
I think the biggest problem is us, the human beings, and our incentives that needs to be resolved. Because the transformation on the platform economy, which is the essence of the fourth industrial revolution, is a transformation from outputs to outcomes. That means instead of operating per verticals, where the product dominates, we need to operate per horizontal definitions. That means holistic perspectives, where the client is really at the center, irrespective of the product the client is dealing with. And that's very complex because it changes the incentive inside the organization, so the way individuals make money. I can give you an example to try to qualify that a bit better. And I might want to compare again, as we did before, the automotive industry with a banking institution. Let's think about a car maker. In essence, a car maker is a manufacturer. They deal with a variety of smaller manufacturers. They produce the individual components of the car, then they assemble it on their chassis, and they allow the car dealers to access through a configuration tool the assembly line in a way that the client, according to the level of wealth, can hyper-personalize the car purchase. So the more money you have, the more you can choose. For example, you might choose a certain Tiptronic or an AV system that is very advanced, or you might pick up an artisan from Italy to make your leather seat. But at the end, for the client, nothing is seen in terms of the complexities of the value chain. The client pays an all-in pricing and goes out with a car, and with that car, the client can go from A to B. Now, what about banking? Bankers are also a linear industry made of manufacturers. You have those that create the investment funds, those that structure the bonds, government bonds or corporate bonds, the private equity firms, you name them all. And then you have intermediaries like wealth managers that assemble those inside model portfolios that they position in front of their customers, which need to take care of their individual cash flows, so the saving, the space for investing, the pension problems, and so on and so forth. Now, what is the problem here? The problem is that as much as you cannot be content to buy a car without a wheel, you need all of the elements. To fulfill your expectations to go from A to B in your financial journey, you need all of these elements, maybe slightly different elements, but all of them, one next to the other. We all need a bank account or a form of in the digital world. We all need a payment method, being a credit card or a digital wallet. We may all need, if you have some money that we spared to invest that money into a product or to think about retirement, or we might need insurance for the protection of our children and beloved. But you see, we cannot be happy if we only have the chance to access one and not the others of these elements. And that happened, unfortunately, for the bank, not necessarily at the same time. So it's the capability of the bank to see that the relationship that enable the client to consume all these elements on the platform at once and pay for that relationship, as the value will be positioned in very different times. But all of these elements needs to be one next to the other to make sense, that transforms the relationship and transforms the organization, so that you don't have business units like in the past, but you have an horizontal engagement method in front of the client where the products are just opportunities, assets that are needed to be used to do something, but they're not anymore the center place of the revenue generating mechanism. This is happening more and more. Those institutions that will understand that deeply, that's the reason for banks and fintech and platform economies have higher chances to make it happen for their benefit as well as the benefit of the customers, as they can generate more value for them.
So Paolo, you talked about opening the firm inside and outside based on new ways to share data. The recent acceleration in the digital adaptation of consumers that follows the experience of Chinese consumers are fundamentally changing the process of accessing and managing data. Scraping has been used actively by fintechs and service providers to obtain access to customer data without notifying the bank. And currently, open banking has introduced a new era of innovation, but this acceleration often leads to vulnerabilities in the cybersecurity systems as well. So what solutions to this problem do you see, and what mechanisms will improve the protection of personal data in the future?
This is a super important question. The pandemic accelerated the digital adaptation of many consumers, in particular in the Western world, as they were lagging behind the experience of the consumers in Asia Pacific. But that opened up new vulnerabilities. In the 2022 CEO study of IBM, Institute for Business Value, we interviewed 3,000 CEOs of corporations worldwide, of which 270 of banking and financial market institutions. And among the many things, we asked them which are the greatest challenges for their organizations in the next 2-3 years. The response was clear-cut. Almost 80%, south of 80%, said cybersecurity risks, followed by regulation and then the problematics of implementing consistently sustainability. And these interviews were done at the beginning of January, before the unfortunate Ukrainian war. So you can understand that now the concern may be even higher, as even states can participate into the cybersecurity game. Now, cybersecurity is foundational to open up towards ecosystems by leveraging open banking, open finance, and open data on hybrid cloud. It is necessary as you might start creating a numerosity of connections that are not standard or traditional, like those that happen when a client goes to a branch. So it's a precondition to accelerate business transformation in a way that it is trusted. But there's something which we also need to realize. It might not be possible for an institution, notwithstanding the capabilities and the investment in cybersecurity, to be 100% safe. A breach can always occur. So it is as equally important as the cybersecurity element, the capability to address cyber resiliency, so to make sure that incidents can be detected and problems can be remediated very fast. We made another study that has been done by IBM Security with the Openness Institute about the cost of data breaching, that identifies the time it takes to identify and to remediate as a key driver to amplify the cost of a data breach for the institution, for the customers. And the solution can be found in plugging in artificial intelligence and automation in order to accelerate, so reduce the time to identify and reduce the time to remediate. So this is an important example where artificial intelligence can be used in order to counterbalance the growing power of the RAG actors, which are also employing exponential technologies to make their unpleasant job for us, and also not just to fight back, but also to make sure that whenever we lose a battle, we remediate very fast to make sure that the business continues in the best interest of everyone, and in particular in the protection of the investors and the final consumers.
So fighting rogue actors and cyber scammers is also about recognizing qualified actors. Biometric identification is already actively used today in all spheres of life. Is there a chance that fintechs and banks will soon completely switch to biometric technologies? And how will this change the order of things?
That is a foundational change. Let's see it why. The history of money is not the history of money, it's the history of qualified identification. We used to go to a store to buy a product and showing cash to the cashier. And if the cash was not enough, we had to go out to the bank to collect more money and to get back and pay. Now, luckily banks opened ATM machines and therefore we can now collect the money through an ATM machine instead of having to queue up in front of a branch teller when the branch is open, because branches are not always open. But something important happened, the credit cards. Now, the credit cards enabled us to be free from the slavery of going to collect cash at an ATM or in front of a teller of a bank branch. But if you think about it, what does the credit card do? The credit card is as much as a form of money as a form of identification that you are a qualified individual that has money in your bank account. So it identifies you. Yes, your name and surname will be seen and forgotten after a moment by the merchant, but the merchant is reassured that basically you are a qualified individual. Now, as we indulge more and more in payment through our mobile wallets and mobile technology, it is the transformation of that identification of your persona and the quality attached to you, like the money in your account, that transforms the financial services industry and enables money to circulate in a completely different way. So you can abstract this from the simple payment example and look at the way you qualify a borrower for a credit decision making or an investor in terms of their capability to access complex investment opportunities. So it is an essential element of the digital transformation that IDs are digitized, so all of the technologies like biometrics that facilitate that digitalization, so the digitalization of IDs are in essence a strong engine for the digitalization of financial services themselves. That's why banks should really take care about that and most likely drive the process.
Do you have any ideas what could follow the biometric technologies in the future? Any thoughts on that?
Well, there will be different technologies that can unlock more value. Of course, the essence is always about the business model. So what is the business model that makes sense so that the technology can amplify it? I think there's one technology in particular which we started seeing appearing at the horizon. We haven't yet grasped the full benefits, but we will see more and more happening in the future. That is quantum computing. Quantum computing has extreme potential to transform the things we do because it might unlock new ways of doing work that currently are prevented to be accessed because current computing methods are not allowed to resolve the problems that quantum computing might resolve. Researchers are effectively involved into the creation of a variety of use cases, so I guess in the next 5 years we'll hear more and more about quantum computing, especially in financial services.
So let's move to another question. It is no secret that artificial intelligence can become the basis for creating next generation financial services. And many banks are working on the development of emotional neural networks. Are there any examples of the most striking achievements in this matter? And probably what other trends in banking informatization will rapidly gain momentum in the near future?
Well, the word emotion is important because money is emotion. And it is emotion because it is linked to the survival mechanism. It's there for us to be capable of surviving in a complex world. So I don't have to be growing tomatoes and you growing potatoes, but we can have this conversation and this interview, everybody working in a different field of financial services or technology. But what matters here is that it's not just emotion per emotion. It's about how that intersects the creation of awareness being generated by an algorithm or a human being to generate value in the decision-making process. Again, the resolution of the asymmetry of information, the resolution of the pull-push motivational gap. Now, I always say that the financial market transparency theory and principle that underpin my Banks and FinTech on Platform Economy recent bestseller is about the identification of the two biological macro foundations of financial decision making. There is fundamental uncertainty and the irreversibility of time. So we don't know about the future, and we know as human beings that our future is constrained life to death. So now I identify the capability to relate with these two problems as an element that generates a conscious decision making, therefore unlocks hidden value in the financial services relationship, because we are more aware about relating with our real problem. That means surviving with money and doing good, surviving with purpose on the irreversible time. Now, if you look at the scientific field, in neuroscience, there are growing theories around the source of consciousness, and some are effectively discussing the fact that consciousness scientifically might not be a passive state of mind, like we are awake, we are conscious, and it is an attribute of the human being, but it's actually something that is triggered in intensity when we have to deal with complex cognitive problems, in particular emotions or decisions, and in particular those decisions that have to do with fundamental uncertainty. So the more conscious we are about fundamental uncertainty, the more we can act and make decisions that are for our benefit, for our survival. And so all of those examples that they provide indicate that effectively consciousness is an element that grows together with our capability to deal with fundamental uncertainty. And the second element is our need to predict the future. As individuals, we always want to think about what will happen to us or to our children. So we need to have a sense of purpose. We need to make decisions and plan for the survival of ourselves and our family. So we need to relate with what I call the irreversible time. Now, time is an epistemological criteria of the Homo sapiens to understand the structure of reality and therefore relate with purpose, with fundamental uncertainty. Now, if I say that, you see that I'm now drawing a parallel and a straight link between neurobiology scientifically and the neurobiological macro foundations of the financial market transparency theory, that is a theory of platforms, of complex systems, of open banking and open finance, to make better financial decisions across the ecosystem made of many actors. What happens with technology is that technology needs to support these decisions, and sometimes technology replaces some of these decisions. So artificial intelligence, in essence, whatever it does, needs to be subject to the same scrutiny of human decision-making in finance and the understanding of what artificial intelligence can do in the relation with fundamental uncertainty and the reversibility of time. The first means how to make uncertainty endogenous to the AI algorithm so that it does not collapse and it becomes anti-fragile. Recognizing that data is not complete, even big data, so AI needs to be not only robust, but also explicable and transparent. And at the same time, the problem of the ethical AI, it is a problem of purpose, it is a problem of time. Time, as I said, is an epistemological criteria of the Homo sapiens. AI is not human. So the problem here is how to make sure that it does not contradict the irreversibility of human time on a planet of finite resources. So the way to do that is to make sure that as much as we use regulation to envelop the action of financial markets, financial institutions, and technology used by financial institutions, that is what I said at the beginning, the essence of the research, business models, technology regulation. But we also need to make sure that AI is also enveloped in regulation in the way it is utilized to make sure that it's done for the good and doesn't fall apart. So that is absolutely a key element, and we saw that regulators are acting more and more these days to understand how to also draw a line that enables people to relate with the technology problem and understand for everybody's benefit how that is used and leveraged. You can see this example of envelopment with a real example. I like again to make an example that links in the automotive industry. Many talk about the self-driving cars. We see some of them are already tested in our streets. In some cases, we see some problems. What is the problem? It's very difficult for a self-driving car to relate with the fundamental uncertainty. There are events that occur in reality that cannot be easily predicted and related to by the AI algorithm, or misunderstandings, for example, on street sign that were, for whatever reason, modified by somebody that was walking by with a pencil. So the simpler the environment around the car, the easier is for the car to self-drive with success. So if you apply it in an airport, for example, where the connecting points of a bus are more simplified because the bus can only go from A to B, point to point, the chances that everything will be operated by AI are higher compared to you trying to operate a self-driven car by driving in one of the wonderful Italian cities that might not be so tidy in terms of the way people drive and the signs are represented compared to an airport. And the same, therefore, goes with AI technology. If you have a washing machine that is supposed to operate by itself, collecting the dishes after dinner, you know that the washing machine knows what a dish is, what a glass is, and they can basically fill in your washing machine and make it happen. But suppose that your kid leaves an iPad on the table. The AI might not be trained to know that an iPad is not a plate and put the iPad inside the washing machine. That would not be good, right? So you need to envelope it in a way that you reduce the amount of uncertainty, actions that are not forecasted that can happen inside that framework. So that's also the role, if you like, of regulation, to make sure that everything is inside a certain perimeter, in the recognition, however, that when it comes to financial markets, it is not possible to envelope that completely, because time series are not sufficient. So we need to keep the framework open and continuously adjust that to make sure that we understand the impact of the application of technology, the application of new business models, and the transformation of financial services in front of the clients.
In your bestseller, Banks and FinTech on Platform Economies, you talk a lot about the prospects for the development of the banking system. So how do you see the banks of the future?
Well, the bank of the future is a bank that needs to operate transparently on the platform economy. So the bank of the future needs to do these two things, needs to understand how to open up their data coffer, commingle with external ecosystem data, and generate contextualized experiences for the clients where friction are minimized, and the scope is basically to help the client fulfill their journey. But at the same time, the bank of the future becomes not an overly product-driven bank, but a bank which is focused on creation advisory platforms where conversations become intelligent, supported by technology, and people pay for accessing that advisory element. Products are just a conduit. They will not be anymore the core of the monetization framework, because in the end, through negative interest rate, passive investing, commoditization of all the bets, they are reducing their margin contribution anyway.
Paolo, being a voice of FinTech, you meet a lot of industry representatives and probably follow their ups and downs. So what FinTech success stories are the most inspirational for you?
Well, I think that those that understand the nature of their clients beyond the narrative and focus more on the long term instead of the venture capital money. I know that everybody is obsessed by the generation of profits. They are important, it's not they are not, but they might force you to miss the point and not scale up the way you want. So I'm more interested in looking and talking to the FinTech that really want to focus in the generation of value. They have an idea on what value is, and therefore we can work together on how to digitize that value.
Okay, thanks. And what books could you recommend to our viewers and listeners? And what do you keep at your bedside table?
Well, I typically like French literature just to change the mindset and focus from technology and banking. But there's one in particular which is a fiction book that I think is relevant, which is the Foundation Trilogy of Isaac Asimov. It is a story of psychology, neurobiology, platform theory, incentives, consequentialist ethics, positive and network effects. So if you go back and read it and apply some of the concepts that I described in my book, Banks and FinTech on Platform Economy, you see how much that a 1950s piece of literature was already thinking in terms of the creation of different incentives for the generation of a common good. That was the reduction of the Middle Age after the collapse of the empire. It could be the collapse of the financial system, but hey, I let you read both books, mine and the one of Isaac Asimov, and to draw the parallels.
Paolo, thank you. Thank you very much for talking to Andersen. That was a pleasure.
It was indeed my pleasure and honor to speak in front of your audience.
Hope to see you soon.
Ciao.